Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Live, and I'm honored tonight. We have a guest that flew in, John Kutzmita. John, actually, when I was in Puerto Rico last November, I met Brent Johnson, and Brent and I have podcasted several times on the show. He has the dollar milkshake theory. John, actually, you're a co-host of your YouTube channel. You guys do it together. But it's interesting because Brent called me a couple of weeks ago and said, hey, you and John ought to get together. And this is what he said. I'll tell you. He said, it'd be nice to get somebody on the show that doesn't agree with what you have to say. So I thought, you know what? Hey, that's a great idea. We've done it before, but John and I are going to agree right off the bat to disagree on some things. And but, you know, with what we have spoken off camera, I think we actually agree to more than we disagree to, fundamentally speaking, in the housing market. You serve the housing market, so welcome. Thanks for coming in. I didn't realize that you were living in Australia. I thought you were in Hawaii. You lived in Hawaii. Now you're in Australia. But anyway, John, welcome. And tell everybody who you are and what you do in the housing market business.
Well, thank you for having me. You know, you do a phenomenal production here. It's very well done, very well prepared. So good, in fact, I was willing to fly, I should say, 24 hours to come and join you. Now, I was actually already coming back this way for business purposes, catch up with family. And as you mentioned, the opportunity to join you here was presented, and you know, I jumped at that opportunity. We did have a fun introductory phone call to kind of feel each other out. It was supposed to be 5-10 minutes, turned into 90. Right. And we said we should have put the cameras on. Right. So hopefully we can reinvent some of that fire, because it was definitely an inspiring conversation.
I think we will. But interestingly enough, and I didn't know this about you, you lived in Maryland.
I did, yeah.
Yeah.
I spent a little bit of time in Ocean City, Maryland after I graduated from college. It was kind of like not wanting to get rid of or let go of the college lifestyle. And so Ocean City, Maryland is a crazy party town. And so I did about an 8-month hiatus, I guess you could say. And I really enjoyed it there. I love the state of Maryland, and it's good to be back.
Yeah. Well, tell everybody what you do, because you are in the real estate business. And yeah, so just kind of fill everybody in on what you do.
Yeah, so for the last, I'd say 20 years of my life, I've been in the mortgage business. Now, I've operated my own company for about 15 of that, and we are a direct mortgage lender. Now, there's a lot of complexities to how the mortgage industry works that I think a lot of people don't realize. Maybe we could talk about that later after some of our friendly debates, but we recently developed a software product. I shouldn't call it a software, it's more kind of a website that uses AI and algorithmic calculations to help people make the correct mortgage decision. A lot of people don't realize that all mortgage rates are more or less cookie cutter. It doesn't matter what bank or lender you go to. When we're speaking of conforming loans, the loans that fit into a very generic footprint, all those loans are priced the same, and everyone is getting the same interest rate. What you end up shopping for ultimately is what one bank or lender is charging you a margin on top of that. And so we created a tool called lensend.com that basically gives borrowers and anyone who's looking for a mortgage access to live real-time rates, so you don't have to go through all that hassle of talking to people and asking for a rate quote. You can get it all instantly. And then the analytic tools are there to basically solve what exact interest rate you should choose based on your situation in a matter of seconds. And none of that requires any email, no login, no personal information. So we're really proud of that. So that's taking the 15, 20 years of experience I have and trying to automate and disrupt the mortgage industry that I think has become very lazy in terms of prioritizing the customer experience. And that was our main focus with building this.
Yeah. Well, you picked a fine time to launch it.
I know.
Well, I mean, really.
Interest rates are cyclical. I mean, the industry of real estate is very cyclical. I think we saw, the fastest rise in interest rates in a very long time 40-year high inflation led to bond investors dumping bonds, and mortgage rates rose because of that. I think that short yet volatile credit cycle is now rolling over. So I think we will see improvements in both the bond market and therefore lower mortgage rates over the next 2 years.
I interview a lot of people. I do have a lot of real estate industry guests on our show, but it seems, a lot anymore. We've been kind of diving into the macroeconomic market, or topic. There's a lot going on geopolitically. When we're talking about the housing market, it's easy to say people can't afford housing right now. And a lot of it is, and the more I learn, because, and I'm sure, John, you've been this way too, but when you work in an industry for a long time, you kind of get focused on the actual transaction of the client that you're working with right now, right? So, and for me, that's helping buyers and sellers buy and sell property. So, or managing agents and doing that same task. So it's kind of hard to look at sort of like the why things are like they are right now. Why is inventory down? We can guess, we can sit here and speculate all day long. A lot of it is inaccurate reporting. A lot of it is, we're finding lately, has been off-market sales being a big part. When you look at, subject to transactions that are happening, wholesale transactions that are happening, the homeowner on the street's best friend's kid buying their house. A lot of these transactions have been happening without the, being in the MLS. So, so my eyes have been open to a lot of that. But also when we're looking at the unaffordability issue, we have to dig deep and look at some of the reasons why, the investors coming into the market. We'll talk a little bit about that tonight because I want your opinion on some things. And really now, which is really interesting that's happening, and I'm learning this as I'm diving more into these macroeconomics and geopolitical issues, is that a lot of foreign investors are buying up our property. And the reason why they're doing that, or some of the reasons why, is because they're not investing in treasuries, U.S. treasuries. So they have the money and they're going, okay, do I put it in a U.S. treasury or just buy the U.S. land, right? And they're feeling like they'd be safer in a lot of scenarios buying the U.S. land. So we're looking at things like kind of through a lens that is skewed. It's not really exactly like we think it is, and we don't see that. At least I don't when I'm helping buyers and sellers on an everyday basis. But we're going to dive in. And by the way, guys, love to have your comments and questions. Be nice to Johnny. Flew in, for crying out loud. Let's not be too mean to him tonight. It's funny.
I live in Australia. I can take it.
Look here.
Yeah.
As long as you don't say date the rate.
Okay.
That's going to be a big no for. Let's just clear the air right now.
No, I'm not going to say that. I've never said it, and I never will. Yeah.
I just heard the CEO of Redfin say it on a podcast.
Yeah.
Anyway, you guys can drop your comments to that, but let's dive in, because, and I'm not. Look, this has nothing to do with your competitor, or I don't know whether your competitor is not, but GoBankingRates.com published an article here that's basically said that there are 10 areas where home prices are plummeting. And we're going to go over them real quick. Portland, Oregon, San Francisco, San Antonio, Raleigh, San Jose, Denver, Kansas City, Cincinnati, Oklahoma City, and Miami. John, what do you think? What do you think is going to happen to the housing market as far as prices?
I would start by saying your introduction to the topic. You mentioned, I think you used the word kind of, things are kind of skewed a certain way, one way or the other. I would encourage everyone to Google logical fallacies. Because I think at the same time that we want to spin and say one narrative is falsely painting a picture, it's very easy for us with various logical fallacies based on our own biases or whatnot to to paint the picture the other way, because that's how we want to see the world. I think there's things that, for
You're
example,
going to have to give us some examples. But
yes.
go ahead, finish
So
with
I
what
mean,
you're saying.
everything you kind of mentioned, I could rebuttal and say I don't necessarily think that's the case. The argument now.
You think that homes aren't
No,
unaffordable?
I'll start with, for example, foreigners not buying treasuries. So Brent and I have been doing this podcast, Milkshakes, Markets Madness, for 2 years now. We've done about 120 episodes. We cover almost the same concepts. The topics are different, but the concept constantly is that the narratives are always ignoring what the data is showing.
So you don't think foreigners are buying our land?
They certainly could be, but to say that the foreigners are giving up on U.S. treasuries and therefore all that capital is flooding into the housing market or into buying property and therefore making it affordable, I'd want to say show me the data, because right now the data is showing that foreign purchases of treasuries haven't been higher than they are now in decades. So the data is actually showing the opposite. It doesn't mean that they're not buying property. I'm just saying when someone presents to me that argument, I would say, okay, well, the data I have seen says that treasury numbers are up from foreigners. So that would therefore say, well, show me the data where they're scooping up property. I will also mention that Brent and I have another project called The Macro Alchemist. It's a research paper that we will be doing once a month. We released our first edition today. You can download it for free at macroalchemist.com. And ironically, it's all about the housing markets globally and a lot of the capital flows that have gone out of China, especially into markets like Canada and Australia. If there's ever a housing bubble, affordability crisis, it's in Australia and particularly in Sydney. And in those markets, I think it's much more clear that you've had this foreign capital coming from China into those markets, particularly because they were encouraging it through visas and other types of incentives to bring in that capital. When it comes to the article you just mentioned, I don't know the article, I haven't seen it, but plummeting is meaningless to me. So plummeting is 5%, 10%, 20%. Is it 20% year over year? If so, 20% from what? If those markets were up 80%?
Yeah, they have, Joe, if you want to pull it up, there are percentages that are on the website, but no.
Yeah, before
and again, it's like comparing two houses together too, right? So, I mean,
I get
houses,
it. I'm just saying, before I have an opinion on anything, and I think one of the fun things we'll have in this debate is sometimes I'll just be playing devil's advocate, because I feel like so much of the time, we might have a lot of people still have this like PTSD from the GFC from 2009, and they just can't shake it. So it's every little data point fits into the bias that this is going to be the end of the world. And I'm not saying that that's not possible. I think there is a real probability that we could have a serious economic crisis in this country in the next 24 months. But we got to look at it objectively. And sometimes these logical fallacies come into play. Sometimes the story sounds better than what the facts are actually supporting. And so I do think there's some real weak points in very specific markets, but I don't necessarily see that across the country yet in the data.
Yeah. Well, we'll get into some, a lot of, of the houses that are being purchased by, Canada is probably one of our largest buyers. Foreign buyers. You would think it would be China, but Canada is actually number one. And then I think China is right behind that. But really when we get into, regardless of the fact, we know that they're buying our property, right?
Sure.
And we know that housing is unaffordable. Would you agree with that?
Housing is at the highest unaffordable rate in history, yes.
Right.
Yeah.
So I guess the question comes back, do you think home prices are going to decline?
I think the future, so I'm more in the belief of, not necessarily belief, but I think the way I approach things is to prepare, not to predict. I think there's three things that we all need to be watching. One is the employment rate. The other is inventory. And I think the third is interest rates. And so I think employment's probably the biggest factor to all of the economy and certainly to the housing market. Now, if we see an increase in inventory, even if you have a healthy economic environment and people are employed, because of that competition, you're going to see prices come down. But at the same time, I want people to keep in mind that the Federal Reserve does not control mortgage rates. Mortgage rates are determined by the bond market. And we're already starting to see in the last week of data from the CPI prints to the retail sales numbers today, to the Fed's monetary policy decisions and the Fed minutes, everything feels a bit more hawkish. It feels like recession or a slowing economy is in the cards. And
because you think bonds are going to drop?
I think bond prices are going to go up, which means interest rates are going to drop. So I think it's important to look at things holistically. So do we have some...
You think bond prices are going to go up and interest rates are going to drop?
That's how bonds and rates work. They're inverse. So in this environment where we are potentially sliding into economic uncertainty and inflation is no longer a concern. Now, when I say inflation...
Why would anybody invest in a 30-year fixed rate mortgage if it's paying them less than a bond would?
It always has. There's always been a margin between the bond coupons, what they're going to get on a mortgage, and what they would get on the treasury bond. Now, usually what you're looking at, so if you would look at the difference between a 10-year treasury yield and a 30-year mortgage, they basically mimic each other. And there's always been a spread of...
So when bonds went up to 5%,
that's why mortgage...
Why didn't rates drop?
Because the bond price on treasuries, the price of the treasuries declined. Therefore, the yields went up. And so it's inverse. So what you actually had was the interest rate on treasury bonds go up because investors were selling bonds, right? So as investors were like, inflation is at a 40-year high. I don't want to be stuck in fixed income because inflation erodes the principal value of money.
Well, they have to encourage people to reinvest in them. The reason way they do that is raise the interest rate so they can make more money.
But the Fed has nothing to do with the treasury yields.
But you're not investing in treasuries if the rates drop.
What do you mean?
Why would you invest in a treasury if you're not getting a decent return?
Interest rates on treasuries are dropping because people are buying the bonds. I'm
talking about the bond market.
Yeah.
Yeah. They're not buying the bonds.
Who's not buying the bonds?
You just said people aren't buying the bonds.
No, I'm saying the reason why interest rates went up the last 2 years is because of the inflation numbers. Investors don't want to own bonds when inflation is uncertain because it's going to erode the principal value of their investment. What I'm saying now is the inflation outlook is certainly not one where people are thinking, at least bond investors are thinking, that inflation is going to keep going up at the 4 to 6 to 9% trajectory it did from 21 to 22. We're seeing year over year inflation numbers on CPI at 3%. The Fed has a target of 2%, right? So if the bond market agrees with that, we don't have to get into whether you believe the government numbers of CPI. The market trades on that. So if the market's like, okay, inflation's not as scary as it was, I could go for buying a 5-year treasury bond and getting 4.5%, right? The more money that flows into that bond market is going to push the price up and interest rates down. Eventually, investors are making the same decision about mortgage bonds. Now, your question is, why would they go and buy a 30-year mortgage bond and get 6% when they can buy a government treasury bond for less duration at 5%? Generally speaking, people are assuming that 30-year mortgage bond is going to pay off somewhere between the 5 to 10-year mark. So that's why you see yields on mortgages almost mimic identically the 10-year treasury bond.
You think mortgage rates are going to drop?
I think mortgage rates are going to drop because I think we're already seeing money flow back into the bond market, the treasury bond market, which is pushing treasury yields lower. Mortgage bonds are going to follow suit. We've seen that the last 2 weeks. So we've been on a nice, slow, steady improvement. Mortgage rates, when you look at mortgage rates as a national average, it's a very ambiguous number, but we'll use it for argument's sake here. It's dipped back below 7%. What we call par in the mortgage industry, meaning an interest rate where there's no fees on either side of it, that's now 6.5% on a conforming mortgage. So we're getting back to an environment where I'm not saying affordability is being solved, but again, looking at things holistically, if you have an uptick in inventory, okay, that could help on price pressure, but at the same time, you're seeing interest rates declining. That's going to bring buyers, in theory, back into the market. So I think I'm less of the mind that you're going to have some sort of dramatic crash in housing, because I think buyers are in on the sidelines. And if we do see this trend in interest rates continue over the next 2 years or even just 6 to 18 months, I think it does put some support under the housing market. Now, there's plenty of markets that got way out of control. I think the poster child of all of this is Austin. And is Austin going to continue to suffer? Maybe. But everyone knows real estate's regional, and so it's dangerous to look at articles that are handpicking 10 cities because they're the most hyperbolic and making a point like there's some broad-based economic or housing crisis in the U.S. I'm not saying it can't happen.
Yeah.
I'm just saying I don't
So you
see
think
it yet.
people are in pretty good shape financially?
I think from what I'm seeing from credit reports, et cetera, and the stuff that we're, working with the clients that we see, I think they look about the same as I've seen in my 20-year history, which is a lot of people are levered up. They are, they're under a lot of credit stress. And so the question is, does this interest rate situation create an environment where people can refinance that high interest rate debt that they have become so accustomed to doing so they can reduce their debt obligations?
That's back to the date. That's a nice way of saying date the rate.
No, it's not. It's a way of saying that people haven't learned in 3 decades how to live within their means.
Their lesson.
They've learned
Right.
to finance that. And
Right.
and yes, whether you're looking at governments coming in and taking over Fannie Mae and Freddie Mac in some form or another, and conservatorship, et cetera. However you look at the various types of bailouts that have happened, it's kicking the can down the road. I get that, but that's the economic system we're in. It's debt-based, and if the debt system does not continue to grow, it implodes. And this is, I think, where you and I agreed on our first conversation. I don't think it's a healthy system. I don't think it's sustainable, but I also don't think cheerleading the end of that system will bring the result that people are really prepared for. I don't think people are really prepared for a situation where the entire system implodes. Mm-hmm. And I don't think governments, banks, and all of the lawmakers and decision makers of the world are going to let that happen. So I'm much more of the belief, probabilistically, that they're going to kick the can again. And so how and when that comes in, does it come in before crisis or after?
Yeah.
We'll see.
So let's talk about interest rates, because we'll talk about the can kicking, because we had a conversation about the Freddie Mac, the opinion that was put out there for Freddie Mac basically buying second mortgages, trying to tap into the equity that they think America has. And so I'll say, before we get into that, it's interesting because I spend a lot of time driving around, and we're probably in one of the most insulated states that there is in the country. I mean, we're right here at the government. We have the federal government, we have Washington, D.C., we have, military installations, we have the FBI, we have it all, right? NSA, we have, there's a lot of good jobs here in Maryland, right? And, but I also see with that, and we're probably in the median income somewhere around $90,000 in median income, where other parts of the country, I mean, nationally, I think it's 34,000 or something.
Wow.
But I say that because I'm out on the street every day driving around. We're helping serve people that would love to buy a house. And we're starting to see in the neighborhoods the decay, the showing up of financial distress, right? I mean, I don't have to pick the 10 top cities that are that exploded the most. We exploded 20-some% year over year. I mean, I think that's pretty bad, right? But I also see where people have put the brakes on, and we're seeing buyer remorse like we've never seen.
Yeah.
I've been in this business for a long time,
Yeah.
right? Serving the housing market. 35 years. Okay. So when I talk to people that, when they say this will never happen or whatever, I just go, okay, we'll see. I remember the late 80s, early 90s, right? Well, we had people being foreclosed on in big scale. Certainly we've had an amazing run. The financial crisis, we were the first in Maryland. We were the hardest hit and the slowest to come back. So we're not just looking at top cities and published in some article. But my point is that let's get back to, I want to just say, is laying the foundation, because it's one thing to hear even you say it. You talk about these, sites that, oppose what's being out in the public, saying that they're not true or not accurately depicting narratives. Well, I could say the same thing as you, saying that I see things completely different as you do. And then I could really dive in and say, well, how many loans are you doing? Is it a big drop off compared to, 5 years ago, right?
Yeah.
So, I mean, everything's relative, right?
This goes back, for me at least, to the logical fallacies and the idea of how many people can you or I talk to, 5, 50, 500? I'm not basing, again, I'm not applying my bias to this. I'm just trying to step back and look at the forest for the trees.
Yeah.
And so it's not about my personal experience, because that's how a logical fallacy comes in and you start painting things into your narrative. I'm just saying so far.
It has to be personal experience. If you're in the industry, you're seeing it firsthand.
Yeah, but if I'm seeing something firsthand and it's 100 people, I can't then extrapolate that.
How do they come up with CPI? How do they come up with their inflation? They're polling, sampling,
right,
people. How do we know what inflation is? Well, they're taking a sampling. I mean, if you take a good sampling of 100 people and you say that 30% of those are XYZ, I think it's fair to say that it's, you could say it's just an isolated thing.
Sure.
But then you have to talk to other people that are in the industry across the country.
Right.
Which I do. Yeah, but anyway, let's get back to interest rates, because
I think I'll add one piece to that. I'm not in disagreement that there's definitely, we need to be on our toes here. I think it's more of a devil's advocate pushback, because there is because of the affordability issue, I think there is a hostility about the current situation. And I think the natural tendency is, if you can't benefit from the current situation, you're frustrated with it, then you want to burn it to the ground.
But you said that this is the first time in the history, post World War II, you didn't say that, but I'm saying it. This is the first time in history where housing unaffordability has been at its worst.
Yeah, I mean, I wouldn't say barely, but it only just surpassed 2009. And now it's coming back down, and it hasn't really been affordable since before 2000. So really, Greenspan, Post.com, that's when we really booted the can and said, we're just going to keep the house of cards propped. We all know what they did during the GFC, and then what the garbage they pulled during the 2020 night fiasco is completely unexcusable. And I'd like to add a piece to that, because I think this is something too that I try to infuse into these conversations, is that it's real easy sometimes when you're sitting from a perch to be frustrated, or to say you want certain things to happen because you've got a not you personally, but stockpile of cash. You reached a point in your life where you're getting, your fixed income Social Security, and you're retired, or even more so, just recently over the last 2 years, you were able to lock in a 2.25, and you don't really care what's going on. You've got $200,000 of equity. You got a 30-year fixed rate that's insane. And so it's fine to jump onto this narrative of like the system's all a scam and there's going to be bailouts, but you were bailed out. You were bailed out in 2009. That's why you still have an economy that functions. That's why you have a house with equity. And in 2020, the Treasury market is the world's global collateral. And it was...
Who was bailed out in 2009?
Everybody was.
Who?
The housing market was.
I mean, we had
the housing
6 million people
I understand
lose
that,
their houses.
I understand that. And again, I'm not forgiving any of this. I'm just saying, like, look where we're standing right now. So
I think Wall Street, banks were bailed out.
Banks were bailed out.
I don't think people were bailed out.
But the housing market recovered, right? We didn't have some sort of 10-year depression. There weren't breadlines. They came.
So we had a 10-year, the housing market fallout was a decade.
For some markets, yes. But it was still there.
If you bought a house in 2006, you couldn't come out of that house and sell it and break even until 2022.
That's not true.
It is true.
It's not true.
And it's true right here. A lot of places.
But again, that's this is your local market,
Yeah.
and that's a pain point you felt here, and I can empathize with this, but that's not the national story.
Yeah.
And again,
Yeah.
go ahead.
Different price points, but yeah.
Yeah.
There are certain price points where you couldn't get out.
The point I make more so that I want to make is in 2020, you had treasuries trading like penny stocks. The market had seized up entirely. It was in completely illiquid. And behind the scenes, if you're having treasuries go no bid, mortgage bonds went no bid. Okay? And at the same time, you had the government, without really talking about what was going on in the financial side of things, decide very, very quickly that it was forbearance for everybody. No one had to make a mortgage payment. Well, the way the mortgage...
This is recently.
This is 2020.
2020.
March 2020. Now everyone's sitting around watching their TVs and all the COVID...
And it took COVID lasted 4 years.
Yeah, but the point I'm making here is that all of that was going on. Nobody was paying attention because everyone's watching the drama on TV. Meanwhile, the entire bond market is seizing up, right? If the government is giving, Congress is giving forbearance to everybody, now that means the servicers, the big servicing companies like the Mr. Coopers and the Quickens and the Rocket Mortgages and all these companies that collect the payment from the borrower, they take a servicing spread and then they pay the rest of that to the bond market. The bond market's guaranteed their income no matter what. The servicers have to pay that whether the income's coming in or not.
Yeah.
Now all of a sudden you have a national forbearance, all these huge mortgage companies now have no income and they have to continue making those payments. So you had a massive seizure of...
They got to pay taxes. And,
all of it.
Right.
So you had the entire housing market collapsing behind the scenes and no one was paying attention. We all know the Fed came in, bailed out the Treasury market, started buying mortgage-backed securities. A month and a half later, we're at all-time record low mortgage rates. So that was a $6 trillion bailout that anyone who owned a home and refinanced into 2.5% benefited from. So I don't agree with any of it. I'm laissez-faire. I don't think this, it's the can't-tell-on effect. Everyone who's close to the faucet, gets more of the benefits. And so I don't think any of that was fair. But the point I'm making is that a lot of people enjoy the benefit of that bailout. But now at this time, when we're getting into talking about Freddie Mac seconds and, people with, various situations who need a credit lifeline, now all of a sudden it's some sort of, unfair, silly government program that's out to steal the homes of all these people with equity. And I think it's complete nonsense. Those second mortgages are going to allow people who are in credit distress to tap into equity that right now they don't want to tap into because the government got involved with markets, pushed interest rates down to record low. They don't want to touch that mortgage. If the government had never did that, and let's say the pandemic thing never occurred, and we had most of the country sitting at somewhere around a 4.5%, 5% mortgage, which is more or less where things were. Well, right now, all of those mortgages would just be doing a cash-out refinance.
Well, you'll benefit a lot by that.
We benefit no matter what. There's loan volumes going on.
Well, you're not benefiting now when there's no mortgages being written.
But
if Freddie Mac comes in and allows people to tap into the equity, you're going to write those loans.
Yeah, but what's the equity going to be? $50,000, $100,000?
Can they afford the payments?
They're paying $30,000 credit cards.
They're not paying them. They're paying minimum payments. You think if they're going to tap into their equity to take the money out of their house and they're buying down credit cards, they're going to shred their credit cards?
Oh, I don't think they're going to do that.
Right.
They've never done that. That's not the point I'm making here.
But I mean, we have to really look at why they have the money on their credit cards in the first place.
Because they can't manage their spending.
A lot of it is they're putting their gas and their food on their credit cards.
Maybe, but again, I think that's extrapolating things to this hyperbolic nature.
That's on that website that you're saying that's fake data.
What website?
Whatever you were saying, debunk what's out on the internet. You think that people aren't charging their groceries and
I don't know what they're charging in entirely, but I don't. Again, this is how we started the conversation.
Yeah.
I don't know if someone has a $20,000 credit card bill, I don't
Should you know that before you write them a home equity loan or a second mortgage?
What they're spending their money on?
Yeah.
Not necessarily, because I think the bigger point is the composition of the situation, right? So if somebody has a $500,000 mortgage, right? And I'm honestly talking about this, the likelihood that I write any second mortgages is extremely low. It's just not in our wheelhouse. But I'm looking at this objectively in terms of the type of people who can benefit from this. Let's say you have a $500,000 mortgage, it's at 2.5%. They've racked up $50,000 of credit card bills, right? They're suffocating under this. I don't know if it's gas or if it's just because they're going out to Buffalo Wild Wings every Sunday to watch football, or what the costs are. I've seen people put college tuition for their kids in their equity. I've seen them put it on credit cards. I'm not here to judge how they're living their life. I think people need to really rein that in, but that's their lives. They have equity that could be used to consolidate that payment to make their financial monthly burden more comfortable. All I'm saying is it's not some sort of gimmick that Freddie Mac is getting into to suddenly trap people into second mortgages so they can foreclose and take over all these properties. You have a 2.5 first, you have a second. Let's say the first is $500,000 and the second's $50,000. That's a $550,000 loan. It'd be no different than if they weren't married to that 2.5% rate. If they had a 4 or 5, people wouldn't be second guessing about going out and getting a 6% combined total 550 loan.
I think what they're concerned about is not taking the home if they can't pay it. I think they're concerned that we have a recession. We're on the heels of a massive recession, and unless we inject cash into consumers' pockets, they're going to stop buying. And when they stop buying, the shit hits the fan.
Well, retail sales came in today. It was revised negative last month, and it was slightly under expectations. So the consumer is slowing. But I don't think, again, going back to this devil's advocate to an extent, I just don't think that's...
Well, they're racking up their credit card bills.
Maybe, but...
That's what you just said it. That's what they're doing.
They're not anymore. So they're either tapped out, or they're getting to the point where, like, I can't keep spending like a junkie because I can't afford the payments.
So what do you think interest rates are going to drop to? What do you think that realistically? What do you think mortgage rates are going to go to?
I don't like predicting. I prefer preparing. But for the thought experiment, you know, the 35, 40-year trend line in Treasury yields suggests that we could see a 2 handle on the 10-year again. So mortgage rates in the 4s.
In the 4s?
Because the margin between the 10-year and the 30 is usually somewhere around 200 basis points or 2%.
Well, then they could just refinance their whole house. They don't need to do a second mortgage.
Agreed. You know what's really possible is, let's say Freddie Mac comes out with these second mortgages. By the time they even get any kind of traction, we could be in an environment where someone's looking at it objectively and be like, do I take a 9% second mortgage with my 2.5, or do I just refinance into a 4.25? I think
it would be lunacy for mortgage rates to go anywhere in the 4s at all.
Lunacy
historically,
in what way?
I think it would be a horrible mistake. That's one of the reasons why we're in this mess.
But we have it's not a switch that somebody flicks. So if investors are worried about the economic outlook, they're going to buy bonds. It's just the reactionary mechanisms that has existed for 40 years in capital markets.
I think that, historically, mortgage rates have been 7 point something percent over a 50-year running average. Been like 7.7%, something like that, for a 30-year fixed rate mortgage. I mean, obviously you've had the extreme of the 80s, right, from the 70s into the 80s, and then you had the extreme low we had since the GFC. It was the first time we went in the 4s.
Yeah, but Todd, I think there's
they did that to stimulate.
But I think there's a disconnect between how the machine works. So almost all mortgages now, it's not the 80s where banks were making loan decisions based on you, Todd Sachs, my local customer who comes in, gets his checking account, the Fed is charging X amount for overnight lending, we're going to tack a margin onto that and give you a mortgage. That's not how it works. Nobody is getting a mortgage interest rate based on Fed funds or because the bank knows you. It is determined nationally by the mortgage bond market. When investors are worried about recession, they're going to buy bonds. When capital flows into the bond market, it's going to push rates, price up on the bond, which push interest rates down. So when I'm talking about mortgages being 4%, it's not because of anyone's deciding that, other than investment capital following the current economic cycle.
Mortgage rates weren't 4% until the Fed started buying mortgage-backed securities.
Whatever the reason that we got there is not the point. The point is the machine and the way it works. The way mortgage rates are determined is the bond market. So if we are unable to get lower on the 10-year and get lower on mortgages without the Fed coming in, that's a totally different conversation. But right now, mortgage-backed security margins are just above 200 basis points. They're right around 220. So if we get, and I don't know this is going to happen, but if we got back into the twos on a 10-year because we hit, so let me take a step back and say this. So you seem to have a bearish outlook on things. You're feeling the consumer is struggling. People are unable to potentially make their payments or keep up with upkeep. Something really, really negative is going to happen. If that is the case, if we went into a really serious economic crisis, interest rates are going to plummet because investors are going to...
And it won't work, just like it didn't work in 2007.
Hold on though, I'm not talking about the Fed making a decision to cut rates. I'm talking about the capital markets, investors deciding to buy bonds because that's what they do during times of risk off. When they buy those bonds, the price goes up and rates go down. So the thing that you're talking about happening because of your experience, everyone's allowed to have an opinion on the market. This is your opinion. If the things you're talking about happen, the knock-on effect is significantly lower interest rates. You're not going to have the crisis you're talking about without significantly lower rates. Even before the Fed responds, even before the Fed reacts. The Fed will be a reactionary mechanism. The market will have already sniffed it out.
We're always too late.
Yes, they'll be responding to the...
I guess where I'm coming from is not really from an interest rate driven perspective. Mine is purely from a consumer struggling, consumer sentiments. So we're not talking about the top 5% of income earners here. We're talking about middle America and first-time buyers, which make up consistently over 30% of their home purchases year over year. I think actually that's dropped in the last year for the first time in a decade. What I'm really getting at is, and it's an interesting perspective, and I don't think we're going to be in the fours. I mean, maybe we would be in the fives. I wouldn't think fours, but I mean, you're in the mortgage industry. But regardless of that, I think the Fed dropping their overnight trading rate would be catastrophic to our economy right now. I mean, we've seen the results of free money and what that has, netted us as far as, I mean, we've gotten more. You've talked about stimulus. We got more stimulus than we ever have. We've had lowest interest rates than we ever have, and we're in the worst shape than we have ever been. And that's certainly arguably, whether that is true or not. But I can tell you that go to the grocery store, man.
Yeah, it's expensive.
I mean, come on, man. Yeah. $100 bag of groceries is like, what did I buy, right? $300 isn't anything at all.
Yeah.
And I see people that are making very good money that can't afford to do home repairs.
Yeah.
And they bought a house, right? All right. So, what do you think? What do you guys think? Huh? Are we having some fun yet? We really do like each other. It's just
this is a good conversation.
It's good stuff.
Yeah. And I want to add one thing. It's not a strong prediction. I'm just saying the 35-year trend line, the support and resistance, I could see us touching a 2% yield. It doesn't mean we sit there for 3 months. Doesn't mean we sit there for a year. It could be 3 weeks. It could be 3 days.
Well, I think here's the nice thing, John, is one day we're going to be able to look back at this and we're going to see what happened, right? And I mean, I think that's the big thing is, I don't want to be right. I don't want to see some major crash in the economy and everybody lose homes. And well, I don't think I think we'll just keep bailing people out. I don't know that we will continue to lose homes. I think people will wonder whether they should have paid their payments or not. They might be like, hey man, I paid my payments and I'm actually the one that's penalized. I paid my student loans off and I didn't get a refund check in the mail. I did, so I mean, I think it's what kind of a message are we sending?
Todd, I'm way more on that wavelength than anything. I think the pushback I have overall, I think we're getting into granular bits here, but the pushback I have is the likelihood that we have some sort of Armageddon crisis is a much lower probability than we have a sharp pullback and then there's a government response. And so to your point, it's the people who take foolish and immense risks, blow things up, either get a bailout or go bankrupt and then jump back into the market, that end up benefiting. The person who's just trying to be honest about it, work their 9 to 5, save so they can, have a family, have a starter home. They're the ones who keep getting stomped on because of student loan forgiveness and all these types of things. So I'm not a fan of the system at all. It's just, I'm not in the camp that we're going to have some sort of 2009 GFC 2.0.
Yeah.
I just don't think that's the case.
Well, I'm not I wouldn't put anything past it because we're in a way bigger bubble now than we've ever been. We've just been kicking the can down the road. I think that, if we see, you said it, the key is going to be what happens to employment, because none of this conversation matters. Interest rate doesn't matter. Home prices don't matter. None of it matters if people start losing their jobs and we see some outrageous unemployment rate, which I'm not beyond, I don't think it's beyond thinking that could be a reality when we're looking at, just some of the automation that's coming. The next round of automation is going to be massive, right? I remember going to school in the 80s and, seeing this introduction to data processing, and that's what it was called back then. And just how that round of automation has probably affected our wage growth. If you look at, housing price growth versus wage growth in America, we really haven't advanced as far as financially, right? And there's a lot of different reasons for that. You could blame offshoring and money going into the pockets of big corporations profiting. Where you have a CEO making $200 million a year, some kind of crazy number. But rolling it back a little bit, because my whole premise is, and what I believe is that a home price correction is 100% necessary. And that means prices have to go down. The only thing that would offset that is wage growth. We would have to see median wage earners not be $35,000 a year, right? And with the way things are going with the Amazon effect, I'll just say, that doesn't look very promising, because small businesses who are the bigger employers in America are not going to be able to afford to pay, and big corporations just won't pay average workers, double salary just because home prices or cost of living's gone up. So I think we have a major disconnect in America. And part of the disconnect is people don't really know what's happening on the street level. The other thing is, so we say, okay, well, how will that happen? How does home price correction happen? If we're not going to see wage growth, people can't afford the house, either interest rates have to drop way low, right? 4% or below. And what will happen to asset prices?
Go through the roof.
They'll go through the roof.
Yeah.
So that's not really going to solve anything here. So
what doesn't solve the underlying fundamental issue, which is, number one, we've over financialized the economy. Number two, we have a huge wealth gap. And everything that went on during 2020 just made that even more excessive. Small businesses were forced to shut down, right? Meanwhile, companies like the Amazons and whatnot of the world just took on a larger share. I think more and more automation's coming from more and more jobs. Does that ultimately lead to universal base income? I don't know, but you start to get into this world of serfdom.
Well, that would be China right now, right?
Well, look,
just building a middle class. You don't have any control, but we're just going to make you a middle class citizen, and you'll have your little
UBI
house.
UBI is a whole rabbit hole in itself. But I do agree that you have, like we said earlier, there's these three pieces. Wage growth is never going to keep up with inflation. It never has. Wage earners have been getting scammed for decades. And so if you aren't buying assets or building a business, you're just continually getting left out. And that's why you have a rise of populism. That's why you have these extreme situations in our political classes. This is why you have Democrats and Republicans fighting. They're fighting for the same thing, but they're being, I think, led astray about where the real problem is. And it's these policies that are being in place to more or less continue a machine of inflation, a machine of making the rich richer. And I totally agree that that's not fair. So you and I are on the same page there. I think there's a lot of the problems start in Congress, but I don't think it changes what's ultimately coming, which is I think we will see a slight pullback in home prices. I think things will become more affordable based on price alone. But at the same time, I think you're going to see interest rates respond to that because of the dynamic of home prices are coming down. It's probably because there's something going on underneath the hood of the economy. I'm going to go buy bonds because that's what I do during risk-off environments. That's going to push interest rates down. So I do think you could have this tit-for-tat situation. Mm-hmm. That's not my 100% case. I'm not predicting that. I'm just saying I'm more on that side of the camp right now than I am that there's going to be this. Because look, if the government can go and print $5 trillion, they don't actually print, but if they can, click a mouse more or less and create bank reserves of $5 trillion that lead to all these other types of things like stimmies and loans, well, what's going to stop them from doing something similar in the next situation to keep the music playing? And okay. I don't underestimate them from taking things even further.
Yeah, for sure. How do you think housing became so unaffordable in the first place? I mean, when we look at opportunity, I mean, look, I love being an American. I mean, it's a great country, right? I'm proud to be here. I think we're, one of the best countries in the world. I mean, where we can have opportunities and make money. But not everybody is geared to be self-employed.
And I wouldn't recommend it.
It's not easy.
Yeah.
It's not easy.
Yeah.
How do you think we got here? And, what about the, look at homelessness. How about the amount of people now that are living in vans and cars, RVs? Now we're talking about tiny homes, sheds in the backyard converted to a home. I mean, how do you think we got here?
I think it started with more or less the first real major bailout, which was long-term capital management. There's a book called When Genius Failed, which is related to the Asian currency crisis. So all the smartest guys in finance basically got together and had a hedge fund more or less, and they put a one-way bet the wrong way. And I think that created the beginning of this profligacy, this artificial Fed put, right? That the people at the top know other people at the top, and we're all going to get bailed out. And if you kind of if you pull the yarn from then, it just gets more and more and more extreme. So then you go into the dot-coms, then you go into the 2009s, then you go into the 2020s. I think it just keeps going until something happens where we literally do have this big reset. And I think people romanticize that. I think it'll be a horrific thing, like guns and butter type of lives. Like you're going to really have to fend for yourself. And before that happens, I could see them kicking the can 2 or 3 more times, coming out with even more extreme bailouts. And I think it creates more poverty, and I think it creates a larger wealth gap. So unless we want to, start lighting these things on fire and start the revolution right here, right now, I think that's kind of my devil's advocate that I push back on people is like, I understand where the frustration is and the disgust for the system, but everyone's still partaking in it to some extent. And so at some point you either completely go anarchist and reject it, or otherwise, the blood's on your hand, maybe not as much as the next person, but we're all kind of participating in this broken form of capitalism.
You said something earlier. You said starter home. I think that along the lines of what you're just saying, we don't build affordable housing anymore. I mean, we just don't. We haven't for years. The cost to build. I mean, look, these home builders are publicly traded too.
Right.
They're big industry. Some of the biggest lobbyists in the United States. Home builders.
So as a builder, what do you think the solution is, given the monopoly that they hold, to be able to build more affordable housing?
Well, you have to redefine what is affordable housing, because if you're thinking about affordable housing from a government subsidy, subsidized affordable housing, that's not affordable at all.
Okay.
I mean, that jacks up the cost to the rest of the community that's being built and developed. The issue is there's a lot of red tape to develop. There's a lot of soft costs that go in before you can even stick a shovel in the ground. I think that, like we did after World War II, we cut the red tape that we had back then, which is a lot less than what we have now, and we encouraged developers to build smaller housing to where they could profit to do so. I mean, and businesses are entitled to a profit. Don't get me wrong. I'm not saying, we wouldn't be in business if we didn't make a profit. You wouldn't. You're in business to make a profit. That's okay. In fact, you want a business to make a profit, especially if it's a good business, because you don't want them to go away. You want them to stay in business. But the issue becomes, if we're not encouraging, and we're stuck in this mindset teaching our youth that this is a starter house, when really it should be just your home. You shouldn't have to worry. I mean, look, many people grew up in a 3-bedroom, 1-bath, 4-bedroom, 1.5-bath, 4-bedroom, 2-bath home that was 1,200 square feet, 1,400 square feet. They didn't know that that was a starter home. The kids are happy. They're playing outside. They're enjoying life. And a lot of those people still live in those houses today. A lot of my friends' parents, they're not planning on moving. The average, person stays in a home for 7 years or, whatever, and you're going to move up, and don't worry, you can settle for this now. You'll move up one day. Don't worry about it. This isn't a permanent thing. I think we should be focusing on laying down roots and being happy and satisfied with where we are. And I think that we should encourage more of that development, because what will happen is, when we think about government subsidized housing as an affordable housing solution, nobody wants it in their neighborhood. I mean, that's what everybody says. Well, that's great, but I'm not here. Oh, we don't want that. We don't want to bring values down, right? So I think we have to rethink what is important in our life. There are certain things that we should be profiting big time on if we're successful at it. Building unaffordable housing in order to make a profit should not be one of them. And so what happens is a developer takes a decade to break ground on a major subdivision. In a lot of cases, they have to go through all this civil engineering. They have to do soil borings and put in infrastructure that costs millions of dollars. And then what happens is if they built a smaller house, they wouldn't make money. It wouldn't be worth it. So we've kind of taken this whole housing market and flipped it upside down, and now we're at, we're now at a point where it's like, okay, well, now what? Because all we're doing is building this inventory, this overpriced inventory. So now we're looking at it as we're selling a payment, not an actual asset price. So a lot of what's happening is we're in a very vulnerable position because these people are buying houses at the all-time high price with a payment that they can afford, or questionable whether they can, because that even changes, right? So now we have a situation where if those asset prices adjust at all, they're screwed. If they come down at all, they're screwed. You need 10% equity to come out of a house on average, by the time you pay transfer recordation fees, commissions, things like that.
Yeah, I have two thoughts on that, if you don't mind me jumping in. One is, I think there needs to be greater accountability to everyone involved in the process, from the loan originators to the realtors. And there needs to be more of a fiduciary responsibility to when and how you are encouraging people to enter
100%.
These housing markets. There's too much of just straight profiteering.
Yeah, 100%. But that has nothing to do with the builders, because they don't even have realtors.
No. So the other thing I would add is, because we kind of talked about this earlier, I think the real point that you're making is the financialization of real estate, how people have turned it into a game of fix and flip to profits, instead of just, this is your house, this is where you're going to raise a family. I kind of have a thought on this. I feel like, because what I've been seeing the last 18 months, as people have been kind of tippy-toeing back into the market, again, the data you presented, I think you got to take that into consideration. If you're an active buyer right now and you're watching certain markets coming down 20%, you should be asking yourself, is this going to happen in my market? And the same type of debate we're having, they should be having in their household. Like, what do we believe or feel could happen? What's the data suggesting? What are the experts saying? I think what has been going on, at least since after the GFC, is the financialization of real estate was already a thing, rich dad, poor dad mentality. But I think people have started treating it as a pure inflation hedge. So I think people have finally woken up. I think Bitcoin has helped people realize this. The bailouts of during 2009, and then 2020 was basically a bucket of cold water to everybody. People suddenly were like, wait, why do we exist in this monetary system if they can just do this and print money? And so I think people have realized, if you ever go to a hyperinflationary country like in Argentina, you can see firsthand what it's like when your money hyperinflates. The second you get it in your hand, it's losing 10%, 20%, and you immediately want to put it into something. We don't have hyperinflation in this country, not even close, but we do have a long-term inflationary trend problem. And I think it's now ingrained, it's now become cultural. People are like, I'm going to lose value on my dollar, whether or not this house massively appreciates or not, or now's the right time or not, or interest rates are high or not. But
they don't have money.
No, but before we get into saying everybody's poor and can't buy a house, let's assume at least there's a section of the population who's in a position where they can at least consider buying a home. I think the reason that people are doing it, with maybe not necessarily without fear, but with some level of conviction, is because, if I don't buy this asset, when I look back over the last 20 years, or if I look at my Gen X parents and what they've experienced in house appreciation, like, I just need to sink this deflating or inflating away paper money into something, so that even if there's bumps along the way, even if my money goes to zero, I'll at least hold this house. Now, what a lot of people are waking up and realizing,
that it costs 3 times to buy the house when they pay for the mortgage payment?
Well, there's that, but I think it's more so that owning a home is, even if you pay it all cash, you never own it because you have taxes and insurance.
Yeah.
And these are also things that I think.
And it's also a depreciating asset.
Yeah, but I think one of the reasons, I'm just adding to the fact that you're talking about affordability.
Right.
Whether things are affordable or not, I feel like people are, one of the reasons homes aren't affordable is because inventory is low, which means buyer demand is high. And I think people are just like, I understand real estate, I can live in it, I can rent it, I get the dynamics of it. I don't understand the stock market. Nvidia's up 300%. What's Bitcoin? I don't get it. It crashes, it's a scam. So I just need to put this money, which is going to be 10% less than what it is now next year, in something. And I think that's a big part of the psychology of the housing market, whether that's healthy or not. That's just something that I feel like is a possibility.
Yeah, no, I'm with you. We talked about one reason of unaffordability.
Okay.
That's in the new housing market. What role, and you kind of touched on it with Robert Kiyosaki, right? Great book, by the way. Rich Dad, Poor Dad, right? What do you think about the role investors have made or have contributed to with the unaffordability crisis in housing?
I think they're an easy scapegoat. I don't have enough of long-term data to be making these arguments. Again, I've really pushed the whole try to stay away from logical fallacy things. I would say I think they help affordability. Certain types of investors do because they're the ones that are going in taking risk, taking hard money loans at 15%, taking something that's not a livable piece of property, fixing up and improving neighborhoods and adding inventory to the market. It's a little different than big investors coming in and buying up properties for buy and hold purposes and eliminating inventory. But that, at least on the large scale level, the corporate level, the Blackstones of the world, that's less than 1% of housing supply. So I think investors play a pivotal role in the housing market overall, and I think they will continue to do so because going forward, you're going to have a lot of baby boomers leaving this planet, God bless them, and those properties are going to need to be upgraded and prepared for younger buyers to come in and take them over. And I think that's...
When you say less than, the Blackstones of the world are less than 1% of the rental population.
Less of the housing, 1% of the housing inventory.
Of the housing, rental market. Do you know what that number is?
No, I don't. I could get that pretty quickly because I have a chart saved, but I didn't look at it before we got on the call.
Well, I have some numbers here.
Okay.
As of 2021, there were 14.3 million single-family rentals in the United States. That's 33% of all renters. 1 in 3 renters in single-family homes, not apartments.
What was the 33% part? So you said 14 million rentals.
14.3 single-family. I'm not talking about multifamily apartment buildings.
No, I understand. So single units.
14.3 million single-family rentals in the United States.
Okay.
33% of all renters, including multifamily, are in single-family rentals. Okay. That would indicate that there's about 42.9 million households that are renting single-family houses. I'm sorry, that are renters. 42.9 million households are renters in America.
Okay.
That's a pretty big number, almost half.
Okay.
Right? And according to the United States Census Bureau, we have about 127 million households in the U.S.
Okay.
All right? So that's about 33.8% of the households
are renters.
Yep. That's probably a pretty accurate number.
Okay.
60-some% home ownership.
Okay.
I mean, the government's always trying, in the past has been trying to push that number up, right? To get people to contribute more to GDP. They're going to fix it up a lot nicer if they own it than if a landlord owns it.
Property taxes.
Yeah, property. Well, they're getting the property taxes anyway from the investors.
True.
Right? Yep. Somebody's paying the property taxes. So my question is, does it really matter whether it's Blackstone's that are owning 14.3 million single-family rentals, somebody's owning them, and it's an investor. And whether it's a small mom and pop investor that has one or two or whatever, the fact of the matter is that we know that a third of the buyers in the single-family market have been investors. That's a big number.
Okay.
We know 30-some% first-time buyers, 30-some% are investors.
Well,
Buying it for rent.
Yeah, and the number of sales that are all cash indicate something similar.
Well, that's the other thing.
Yeah.
So my question is, do you think that that's right, that we should allow the profiteering to exist in the single family market, or do you think that real estate investors, especially the Blackstones, should be focused or prevented from playing in that market? And I know that's kind of a question, it's kind of, because we're capitalists, we're
Yes,
land of opportunity, but how do these numbers are pretty staggering. And when we're looking at a lack of inventory and people that are renting these houses that would rather buy them, they want to be, a third of all renters are in single family homes. Obviously 1 in 3 want to be in a home. They're in a home.
Yeah, so I wouldn't sneak in the word Blackstone, because then that becomes the focal point of the conversation. We don't know how much we could.
Well, you said the Blackstones, so the Blackstones of the world.
Blackstones meaning private equity versus how many of that is mom and pop. But I think across the board, my philosophy in general is far more libertarian about all of it. I don't think we should be getting involved saying what someone can or cannot own. I think the market will regulate itself. The problem is we don't let that happen. And the second that there's any kind of issue in the capital markets, they get bailed out. And especially when it comes to the consumer, mainly because the consumer votes and politicians want to hold their positions of power. And so they're going to find a way to win those votes and save their constituents. And I think if you did not have the housing market treated as the cornerstone of our economy, real estate wasn't such a big lobbied industry, et cetera, then that would balance itself out, and a lot of that capital would find a home someplace else. It would seek yield elsewhere. And during the period of time that a lot of those Blackstones were entering the single family rental market, it was almost purely because the Fed had enacted ZIRP for 15 years. They had kept interest rates at zero, so these massive entities with tons of capital couldn't get yield. They couldn't go into the normal capital markets or buy a risk-free treasury bond and get the necessary yield that they needed. Pension funds, insurance companies, these are who the Blackstones and the private equities help manage money for in some cases. So they went into the rental market because it's the only place you could get a cap rate of 4%. So the Fed is directly responsible. So in a lot of ways, it's kind of this, arsonist and fireman in one situation. And so I think for me overall, I don't think we should be going in and saying, okay, we're going to cap you at 3 properties, or we're going to cap you at this. We just need to stay out of markets and stop juicing them and stop bailing them out.
Do you think we ought to charge them more in property taxes? Do you think there should be some kind of a, like a more of a discounted rate for owner occupants and more of a fee-based, hey, you want to buy this house and gain the appreciation over time, or a profit on it from it on a monthly basis? You think that they should pay any kind of premium?
To be honest,
and this is coming from a real estate investor. I'm just asking the question, right? I'm not.
To be honest, because I'm not a policymaker, I haven't thought about that deeply enough. Because on principle, it sounds like a good idea. The problem is, and I can tell you this as somebody who's spent a lot of time, a lot of energy, and a lot of capital trying to reduce my tax burden as much as possible. It's kind of like the whole narrative about the Elons and the Jeff Bezos of the world not paying any tax. And it's, on one hand, it's not true, but on the other hand, that's exactly what happens. The tax system is set up in a way so that
complex tax system.
Yeah, so these entities are going to find a way to navigate it. So it's kind of like water always finds a way. It always finds the crack. It always ends up going to the lowest spot. And I think that's ultimately will be the case. And you can see that throughout the history of our government. Every time they come up with some goofy policy or tax incentive that has some other type of knock-on effect, or businesses find a way to work around it. That's why people are moving to Puerto Rico. I mean, all it does, in my opinion, is further the wealth gap, because the average person who just has one investment property because they lived in it for 6 years and then moved to another state is suddenly now getting triple taxed because the Blackstones of the world, became the boogeyman, and the politicians came out with a policy. Meanwhile, the Blackstone finds a way to loophole the tax policy at the end anyway. So I don't think it just continues the cycle, in my opinion.
Yeah. Let's take some questions.
Let's do it.
All right. All right, here we go. Charles G with the super chat. Thanks, Charles. The people weren't bailed, banks were. Then private equity realized how much they could make on home renters. Now they buy up all of the affordable homes. Thanks, Charles. And and look, I mean, the issue is that for any business there still has to be a profit, right? I can remember when I first started selling real estate, going from a contractor to a real estate agent, and if you watch my channel, you probably know that I wanted a real estate license because I didn't like agents very much, at least the ones that I was dealing with. John, along a lot of the same sentiments that you have, we haven't really, we've been a little loosey-goosey in this industry, right? And to your point, I mean, I think that there has been a lot of contributing from the, a lot of the home value push has been from the industry, unfortunately. Especially when an agent doesn't do but a couple transactions in a year, or worse yet, maybe one, and they don't understand where the market has shifted, and they're still pushing their buyer to pay over list price when they may not need to. So certainly that keeps it going, right? But when I first got into the industry, I was doing commercial sales and helping investors, and there was something called a cap rate. And when you spoke with an investor, they said, I want a double-digit cap rate, right? They wanted a real healthy return, but was it really healthy? I mean, it was probably like what it should be for the risk that's involved and the cash outlay, and then for them to be able to improve the property and provide a better place for people to live and things like that. A lot of it was multifamily housing. But then there became like this 1% rule. So when it became more into the residential market, the investor said, look, if I spend $400,000 all in on the house, I want to be able to rent that for $4,000 a month. Because once that goes upside down, you lose money. And the way investors lose money isn't necessarily on the cost of the debt service and the money that they charge for the rent. You lose the money on the turnover, the tenant turnover. Certainly I've had plenty of rentals where you have to go into the property and spend $10,000 or $15,000, you replace the appliances, and because the home was destroyed or whatever, or it took you 7 months to get out a bad tenant that wasn't paying. I think we're seeing now a lot of landlords are saying that rentals aren't what they're cracked up to be. So the question becomes, and getting into more of what Charles is saying here, was a conversation I had earlier today with someone where we were talking about there are a lot of funds that own a lot of single family houses. I mean, whether it's a 1% figure or whatever, tens of thousands, 50,000, 100,000, hundreds of thousands of single family houses. Well, the question becomes, what happens when they're unprofitable? Right, when they can't get the people out of the house, or they destroy them, or they realize, gee, this sounded great to be in this business, but now that we've paid a higher price for the asset. We're not in 2009 anymore, 2010. So now, how do we make a profit? So I think the question is, will these funds start dumping their inventory, or will they be bailed out by saying, hey, look, you can't dump this inventory because the state doesn't want it.
What do you mean dump the inventory?
Sell it.
Yeah, but they're not going to dump inventory and take a haircut.
Open Door did. Zillow did. Zillow offers dump properties. They lost $770 million.
Yeah, right. But that's different. That's because they were exiting a horrific business model.
So all these people, these funds that have purchased these houses,
yeah,
if they're not getting rents, or they realize that when a house turns over, okay, we made $12,000 on the house in a year, but it costs us $20,000 to re-rent it. What happens then?
So I think this is really at the core of my pushback with these kind of, scenarios. You and I could pull up a whiteboard and come up with 10 different what ifs. And I don't think there's anything wrong with those thought experiments. But at some point, you got to dig below the interesting nature of the story and start applying real data. Like, how many of these, let's just say the Blackstones, because we're using them as an example, how many of their... A large fund has, I don't know, $100 billion or $250 billion worth of real estate. How is that performing? What do the assets look like? How many of them are not performing at all, or not paying, or not collecting rent? We have none of that data in this conversation to extrapolate that because there's such this big whale in that 1% sector, that they're suddenly going to dump, number one, and number two, that it's going to have some sort of cascading effect. All of those things are possible, as are 100 other scenarios that we could come up with. But I think it's important to dig into them a bit more. And I'd like to address the comment directly. Read it back to me if you could.
It says people weren't bailed out, banks were.
Okay, let me address that. The picture I was trying to paint, I'm very, very well aware of who got the checks during the GFC. The picture I'm painting is, and I understand what you're saying, in some markets it took 10 years to recover. That is not true for the entire country. And most people right now who still own a home, in some case or another, can look back and say the reason they still have a job today, own a home, is because of those bailouts that came in. I'm not saying that they were right, and I'm not saying who they were directed to was fair. I'm just saying there was some element of benefit because they got involved. That's the bigger point I'm making, because what I was really emphasizing was the fact in 2020, the bailouts were even bigger and almost everybody benefited from it, and no one even batted an eye. Everyone's smiling and patting themselves on the back because they now have a 2.25% interest rate.
Well, I think the Silicon Valley Bank was the third largest bank failure in history.
It's another great example of where I have a problem with all of this, because that bank got bailed out because of the people involved in it, because it was 1%ers, because those were big tech companies that had payroll in the bank.
We saw $4 billion come out of regional banks and go into the
money market funds. Yeah, I get all that, but I'm just, there's aspects to the bailout stories that I am 100% in agreement with, and I'm very empathetic to how people get angry about it. The point I was making is not that like people got bailouts. I'm just saying there was a trickle effect where it stopped the entire U.S. economy from imploding. Not saying it was fair, not saying it was right. I just wanted to be clear what the point I was making.
So getting back to the point about the investors.
Yeah.
So there's two scenarios. There's the scenario that they realize that the housing market, the single-family housing market, isn't the easiest business to be in, which I think is one of the scenarios, because of the obvious, the management of it. Unless you're buying whole neighborhoods, they're buying scattered homes throughout a neighborhood, so they've got issues, cost issues, maintaining the home with repairmen, things like that, turnovers. But the opposite scenario is that they're making money. That would be the opposite scenario. If that's true, they're going to be buying more single-family homes.
Maybe. I would also say that if they're smart and they've had a good run, their cap rate is probably less than the treasury yields right now, and they would slowly dissolve that portfolio, not where it creates any kind of inventory crisis or it crashes their net asset value. I would imagine they would say, okay, this has been a great run. We were getting 0% in bonds. We were able to scoop up a 4% cap rate by getting into the single family rental business. Those properties have now appreciated, I don't know, over the 10-year period, let's say 40%. So they're now exiting after getting cash flow for all that time with a profit. That sounds like a great investment to me. These guys are, this is what they do. They treated that as a trade. That was a great trade. And so I think they'll ultimately start to exit that trade if the picture you're painting is accurate, and start moving into something like a 5-year or 10-year treasury bond.
Trading with shelter.
Yeah, I'm not.
Shelter inflation.
Again, I'm not in agreement with it, but that's what they did. They were chasing yield. They weren't getting anything in the markets that they would normally invest that capital in. So they were forced out. I mean, this is why high yield bonds are where they are. High yield bonds are a term given to bonds that are very high risk. Could be high risk corporates, could be high risk governments. But the yield or interest rate on high yield bonds is incredibly suppressed, or was incredibly suppressed for a very long time. It still is. And the reason is because people were going further out on the risk curve to get yield because you couldn't get it in a treasury bond. And so I think I wouldn't call it normalization, but I think you're starting to see greater optionality for capital. And those who do have capital, again, this is part of a lot of the things we're talking about here, are getting paid to park that capital, right? If you've got $1 million, you know, you're gonna pick up 45 grand over a year period, right? But if you have no capital, the fact that treasury bonds or money market funds are paying you 4.5% doesn't do you any good. So it's still one of these situations where, you know, high rates are supposed to be restrictive, but they can actually be inflationary until they become a burden either on the government or corporates that are required to pay those higher rates. So part of the sticky or anchored inflation that we're having is the fact that people are now getting paid 5% to sit around and wait. And we haven't had that for 15 years.
Let's take some more comments. We've got a bunch of them stored here. Michael Church, we need a reset starting with all government and corporate leadership, then disband the club and let the people decide on laws and policies like our founders intended.
I can say one thing I do believe in when it comes to making a change. I think we need term limits on Congress.
I think a lot of people agree with that.
Yeah, I think that's a great start. Great start.
All right, so Brad, houses should be a constitutional right.
I don't think they're not. Or you mean like everyone should be given a home?
Maybe.
You're getting into communism at that point.
Right. I'm in Wisconsin. People are putting in 10 to 20,000 over asking price just to get a home.
Yeah. It's so regional right now. I think that's my big push is that the blood and gore of the housing market gets, you know, blog posts open and gets people going, but it's not a national story yet.
Thought people were getting sued over date the rate. Have you heard that? Is that people have been getting sued over that?
I don't know if you can. I mean, the idea of date the rate is, look, I know rates are high, but home prices only go up. Buy the house now at the high rate because you'll be able to refinance in the future. I don't know if anyone who peddled that would necessarily be liable, but this is my point. I think there needs to be greater fiduciary accountability for people involved in the transactions at all levels. I mean, if you look at it in a slightly reverse way, from roughly 2000 to 2020, we could even go from like 2009 to 2020, interest rates had a really consistent decline. How many people over that period of time overpaid for an interest rate that 12 months later was no longer relevant because interest rates had dropped below it at an even lower cost? If you had, as an investment advisor, told someone to buy a stock that was now dramatically worth less than what you told them to buy it at, your reputation would be destroyed. There is no track record like that for the mortgage bros and in the real estate space. And I think...
Well, and to your point, I think that there's no education that goes along with that because people don't realize that it's expensive to refinance. And then they reset their whole amortization schedule, and they may not even stay in the house that long. So, I mean, you know, it may cost them, it may not be worth doing it in the first place.
So, bear with me, a quick plug here. Please go to lenzen.com. The way we built that, you don't have to put in any personal information. We don't collect emails, but you get to see real-time interest rates using the same professional pricing tools that everyone in the industry uses. You'll see a full list of interest rates, and you'll see that lower rates on any given day below the par rate have a fee. Most people refer to that as points, but we call it fee for rate because points can be very ambiguous. Points could be the entire cost of the transaction. We want people to understand that you are paying for your rate or the rate is paying you. So you can actually go above the par rate. Par just means the rate of the day, what the market is currently trading at, because again, mortgage rates are derived from the bond market. So if you go above par, the market's going to actually pay you to take that higher rate. So you're either incentivizing the market by paying out of pocket a fee to get a lower rate, or the market is trying to incentivize you by paying you a rebate to take a higher rate. Now, once you see all those interest rates, you can pick any one you want, and it's going to take you to a summary page. The summary page has broken it down, really, really easy to follow and very simple to use, dynamic touch and play tools that show you exactly what interest rate you should choose based on the points you're making. Things like break even, depending on how long you're going to be in the loan, because the lowest rate doesn't always mean the best loan. If you're only in a property for a couple years because you're military and you're PCSing, or because, you know, just generally it's your starter home or whatever your story is, then a higher rate is actually going to benefit you because you're going to have less upfront costs. So it's just something to consider. lenzen.com because I agree with you, the education piece is so lacking, and we built that site to make it very intuitive.
Awesome. All right, let's see. Let's keep going.
Let's do it.
I have seen my area's price drop by 10 to 15% in the last 6 months, while inventory doubling. Houses also sitting 60 plus days on the market. We are seeing that if the house is not priced where it should be and isn't in very good move-in ready condition, we're seeing price reductions, and we're also seeing days on the market rise. And in fact,
we have 30% increase in price reductions. We have, you know, in a lot of these markets, a big uptick in inventory. And just generally speaking, we have the lowest transaction volumes we've had in decades. So if you are playing games as a seller, you're shooting yourself in the foot. Because even, I mean, the Wisconsin market, there's definitely markets like that, but why are you gonna play that Russian roulette when in general right now you're seeing a trend towards a softer housing market? Again, I'm not in the crash camp, but I do see these weakening scenarios, so I don't think, you know, sellers should be lighthearted about it.
but you also said that we've experienced the most bailouts that we've ever had. So it's kind of hard to gauge it, because if we hadn't had these bailouts, we'd be having a different conversation already.
Agreed.
Right.
And
so the question is, are they going to continue the right to checks?
Yes.
And I guess that's the question.
And I think they will do that until they can no longer do that.
Yeah.
Unfortunately.
Saudi Arabia is no longer on the petrodollar.
That's complete nonsense.
You know,
There's no, so
they're working on a new agreement.
there's no such thing as an agreement. So Brett and I just did our last podcast, covered this whole thing. So the best thing to do is just go watch that.
And that's gospel.
Yeah, because
You know that back in the 70s, the U.S. didn't make a deal with Saudi Arabia.
there was no official agreement. No.
Okay. All right.
Yeah. So we talk about it in the podcast.
Okay. Well, we'll see about that. But I can tell you one thing. So let's just run it down.
Okay.
They have been using the dollar for the last 50 years.
And they still are.
And they still are, right?
Yeah.
But here's the thing. They also joined the BRICS. So, I mean, you know, we'll see how that pans out too.
I mean, it's all important stuff to watch.
Yeah.
I think very similar to the conversation you and I are having about real estate. Brett and I have every weekend about macro, which is that all of these things are really legitimate things. Inevitable is not the same as imminent. And so these things could take 2 decades to play out.
I think the question is, so is it a real agreement or not a real agreement? I mean, certainly, you know, it went wildfire on social media when, you know, it was announced that, hey, you know, somebody, whatever, said that. The way I've had it described to me is that they're working on a new agreement. It's just so happens that we've offered them military protection for all these years. We've invested in their exploration and their refinery, and with whether it was a handshake or some kind of agreement, they have been requiring dollars be used to purchase their oil around the world. And, you know, and a lot of that also, whether it was an agreement or not, was said to be invested, the profits from that invested in U.S. Treasuries. Do you believe that?
Yeah, because they couldn't invest it in their domestic economy.
Regardless, but we've been providing protection for them too.
But where are they going to invest the money?
Well, I mean, where would anybody invest the money?
Well, certainly over the last 50 years, U.S. Treasuries were the right thing to do. But again, I think these are interesting topics, but going into the petrodollar is dead.
But when you say that there was no agreement, I would like to see that where that actually is the gospel.
Okay, well, I would go back and say, show me the agreement.
Right. Well,
right.
I mean, maybe we would say that there's maybe truth to both sides of it, but when you say it's complete bunk, because you and Brent had a conversation about it, I have a problem with that.
Okay, then watch that interview, and then we can follow up with it, because that's a 40-minute conversation in itself. But what I will say is, his comment was the petrodollar is dead.
That's true.
Yeah.
Yeah. I would agree with you that.
Yeah.
Yeah.
So are there movements going on geopolitically everywhere right now? Are we sliding into a multipolar world? Absolutely.
Yeah.
Absolutely. But this jump to the conclusion of the dollar is dead, the US empire is over, the BRICS are going to rise. It's 120 episodes of our podcast.
All right, so Jeff M., I already like this guy. He's spot on. From 1929 on, everyone thought a crash was coming, and it never came. People are stuck in GFC mindset.
Woo! Someone in my camp. Yeah.
If we had a whiteboard here,
John finally gets one.
I'd put a mark there for you. Jeff's a good guy. He's been a long time follower of our podcast, so we appreciate you, Jeff. All right. How do you prepare when you're already on the edge of being broke?
Ugh.
Even if I'm not, I don't feel that way. I feel vulnerable.
How do you prepare when you're on the edge of being broke?
Yeah.
I mean, that's a heavy question, right? I mean, I think just you got to start with small steps. Control what you can control, and don't get overwhelmed by the things that you can't. If you're already really deep in it, you're late, you got collections calling you, you need to at least start with counseling if you're that deep in. But if you're not and you're just feeling overwhelmed, you eat the elephant one bite at a time. And generally your emotions are going to make it worse and make you more stressed out. So I think just focus on controlling what you can control, consolidating the debt where you can, cutting up the cards as fast as you can, and just taking it one day at a time. You'll get there.
All right, here we go. Question for Todd. Would you buy a forever home right now if someone can buy cash and wants to stay there 10 to 20 years? Initial price, 1.3 million. Now at 1.12 million. Offer would be 1 million. Any thoughts, or would you wait? So I think there's a lot of, you're spelling out a lot of this scenario. Number one, can you afford it? If you can afford it, I mean, a lot of home buying is a lifestyle. I mean, let's face it. It's not necessarily profiting or getting a return. It's being able to afford to be there. And if it's your forever home, and I found a place to check the boxes, I 100% would buy it now. I mean, I think, in part of our conversation, one of the things that we know is that home prices have always rebounded and have gone up. And they typically do adjust for inflation. I think that what has happened is that we have outpaced it so bad because of so many different factors, and that I think that we're going to see an adjustment in home prices, or if not an adjustment, a stagflation for quite some period of time. It may be 10 years before we start seeing any kind of major appreciation, home price appreciation. It just may be that we have to wait. I mean, if you go back, my first job, I was making $3.25 an hour. So, I mean, let's face it. I mean, now I was baling hay and straw. It was brutal work. But my point is, you will see wage growth go up, and inflation is inevitable. But I think it's the period of time when I say that we're going to have a housing correction. Everything is temporary. I mean, even if we had a catastrophe with a war or something, high unemployment and things went completely imploded, I think that we would rebuild. We're resilient. I mean, it's not going to be the end of the world. I would hope not. But if I can afford to do something, I'm going to make a move based on what's right for me and my family and whether I can afford it. And at that point, I mean, you would think, at 1.3 million, I mean, I don't know where the initial price was. I don't know the area. I don't know, I mean, you could be in Washington State and 1.3 million not be a very big house, or certain parts of California. But I think you basically, you just said it, you can pay cash. So you're going to save a lot of money right there by not paying some jumbo loan. And so yeah. Charles G, there's no effing way we are going to 4%. We're taking if I had an eraser, that one just outweiged the.
Well, like you said, Todd, the best part about this is we get to look back.
We do.
Yeah.
We do.
So as soon as it hits 4.99, I'm coming back on your show.
All right. Fair enough. It was funny because I had a loan officer on in 22, at the end of the year in 2022. She's a friend. And I mean, it's these conversations are certainly, look, there's probably a little bit of right and wrong in everything that both of us are saying, and as I said, I'm not trying to be right. I think the fact of the matter is we're having a conversation about it, because most people are just saying, buy, date the rate, do whatever. They're pushing with commission breath. I'm going
to steal that.
You can smell it. You know what I mean? You can just smell it on them, right? And
commission breath.
But anyway, so I had this friend on, mortgage loan officer, and she said, "Oh, this is the end of 22." She said, "We'll be back at 4% by the first quarter of 23." Well, I mean, that didn't happen. We don't dislike her because it didn't happen. She was optimistic and wrong, but she could have been right if all of a sudden that happened. People tell me all the time, at least a broken clock. I'm like a broken clock. I'll be,
right.
At
least twice a day.
At least twice a day. You'll be, you keep saying this long enough, eventually you're going to get what you, and then you can claim that you predicted it. Fed rate never reached a real restrictive rate of 10+%. That was required to truly stifle inflation in the housing market. This is a great question. Do you think they raised rates enough?
I think, I don't think, I think the issue was what the Treasury was doing with reverse repo. I think there was too slow of a reduction of the balance sheet. I think the Fed funds by itself isn't necessarily the point of blame. I think it's more so in combination with the other things. Basically, whatever Jerome Powell was doing with Fed policy, the Treasury was counteracting it with governments more or less by feeding liquidity into the system. And so these are kind of the games that they play, right? Like if they really went to 10% on the Fed funds, Janet just would have did more in the back alleys to fund liquidity into the system. And even if they did that, imagine if you could get 10% on the overnight lending rate. If I could get 10% on a 3-year Treasury bond right now, I think it would massively ignite the economy, because you'd be pumping, the government would be pumping in so much liquidity into the system. Now, granted, it's not sustainable for the US government because the deficit balloons, because now they're paying 10% on the debt that they're issuing, but the real economy is now getting this massive capital injection. So I think I'm sympathetic to the point that the Fed could have been more aggressive. Brent and I have talked about this, where I think once they got to a certain point, they got a little bit of escape velocity with the rate hikes, and they got to 4% and nothing blew up. I think they started to believe, the Fed started to believe that they could pull off the soft landing. Soft landing meaning they could raise rates, slow the economy without causing a recession or a crash. And I still think they believe that.
Do you think it's going to happen?
That they'll find a soft landing?
Yeah.
Oh man, I have no idea. I mean, I think they're going to try to cut rates at least once this year. I think just because they've been projecting it on the dot plot for so long, they want to maintain some credibility that they follow through. But I think the data doesn't necessarily suggest that they should, although it's economic data starting to come in softer. I think they could pull it off. I think it depends on what you classify as a recession at that point. Generally, a recession is 2 quarters of negative GDP. We've already had that. And they kind of said, oh, no, that wasn't a recession because employment was strong at the same time, and they kind of added these other metrics. So do they play this word game, right? Word gymnastics to say, well, we didn't really have a recession, and therefore we had a soft landing. So could we have a soft recession and things don't really get really bad and we avoid double-digit unemployment? I think it's possible, yeah.
The rates now are just low enough to have builders, lenders offer buyer buy-down programs as a temporary fix. Until rates impact real unemployment in a substantial way, this is a very smart comment here, the market will resist current monetary policy impacts.
So the part about the developers, so there's interest rate buy-downs, and they really mathematically don't pen out. So don't do buy downs. But you're paying a fee to have a lower rate for a period of time. Yes, there's some developers doing that, but what I actually think developers are doing is, because keep in mind, all mortgage rates are universal. They're determined by the mortgage bond market. This impacts everyone who's doing conforming loans that are going to be sold into Fannie Mae, Freddie Mac, or Ginnie Mae mortgage-backed securities. This includes developers. The developers are building properties to meet the requirements of a conforming loan because they know that's going to be the best way for them to sell those properties. It's the easiest thing to finance. So if you're going to developer, and right now the margins for developers are 30% higher than the mean. So most developers have a lot of fat on their profits. So let's say they're making $50,000 more on a property than they normally do. they can take a portion of those profits without lowering the price. So they're not showing a lower price in the market. They're just cutting into their profit margins because it's...
Well, they own the mortgage companies too.
Yeah, but the mortgage companies are just a conduit. They're just an originator.
Yeah, but they're taking a loss on that side, not...
Correct.
Yeah,
so
they're taking a loss on the mortgage side. They're not taking a loss because they don't want to affect their comps.
No, so they're not reducing the price of the property.
Right.
But they're taking a portion of their profits and paying the fee for rate, like I was describing before. They're paying that fee for the buyer so that they can get an interest rate that's significantly lower than what the existing home market is generally seeing, because if somebody tries to go get a mortgage through us or anyone in the mortgage world, they're going at a price that is universally set. It's universally set for the developers. They just have so much cash that they're willing to pay the rate down for the buyer.
They have to keep their home sales going.
Yeah.
And they can't piss off the people that put contracts in and they're waiting for their houses to be delivered, or the ones that just settled 3 months ago. They can't all of a sudden drop the price $50,000 without upsetting the apple cart.
That too,
So,
but they have the profits to basically buy down the rate. So it's a smart move on their part. But eventually, that's going to bleed out.
I think what Austin's saying here is that rates are low enough that it makes it practical for them to still be able to do it.
But the party said about the Fed's policy being not restrictive enough, etc. Again, they're two different dynamics. The mortgage rate world is driven by the bond market.
Well, what he's saying here is that until rates impact real unemployment, but the Fed rate does affect business.
Sure, it affects,
because that's affecting their revolving credit lines.
Short-term
that's so if you're a business and your credit limit has been shrunken down to where you can no longer buy the inventory to meet a sales demand, or your profit margins are being depleted because you're paying these loans that you've already taken that are variable rates are variable rates. These businesses are going to start letting people go. And I think that's what he's getting at here, is that, right now we're not seeing that because the rates weren't taken to a level that would damage that. Right now, whether it's still practical, we've seen credit tightening at the same time that we haven't really seen as high interest rates as maybe we should have seen to slow down the rate of inflation. But there's that teeter-totter of, if we crush these businesses too much, we really are going to have a skyrocketing unemployment. And
then you're going to have a recession. And then at that point, so keep in mind too, so the mortgage rates started rising in early 2022. The Fed at that point was still saying inflation was transitory. The bond market called their BS, right? And they were already starting to sell bonds because they knew inflation wasn't transitory. They could see it in the underlying data, and they weren't listening to the Fed.
It was 9.1% or something.
But that's after the fact. So I'm saying like February, right? So February 2022, mortgage rates started to rise because bond investors were selling bonds. The Fed didn't raise the overnight lending rate for the first time until March, and it was only 0.25%. By the time we got to the June print, which was the 9.1 40-year high, mortgage rates had melted up dramatically because the bond market they were running out of the building selling bonds. So keeping that in mind, it can be very much the reverse effect. If the situation was that the Fed, maybe they decided to raise rates another 50 basis points next quarter just to be aggressive, right? At that point, does it cause us higher unemployment because things are so restrictive? You're going.
Well, I don't think a half a point would.
No, but yeah. whatever happens. Let's just say the Fed does something to really accelerate this recession. Investors are going to buy bonds. That's going to push the price up and push rates down. Mortgage rates, I think the best thing I can say is mortgage rates are much more likely to decline well before the Fed cuts the Fed funds rate. So don't wait for the Fed to cut rates and think that means mortgage rates are lower. Most likely.
And don't expect your credit card rates to come down if the Fed cuts rates.
Yeah.
If the Fed takes the rate to zero, their credit card's still going to keep you at 30%.
Still going to be at 30%.
Crazy.
And that's a whole other conversation about usury. Yeah.
All right, Apple just discontinued buy now, pay later. Everyone was buying and nobody was paying. That's not funny. I'm not laughing at that. I'm laughing at the way they said it. Everybody was buying and nobody was paying. All right, here we go. Phil Simonetta here, one of our Florida brokers in our network. The numbers he quotes are not accurate. It's all smoke and mirrors, fiat-based. The markets are all controlled. Free market is gone. It's going to implode. A matter of time. He's bearish, like me. All right, here we go. Jeff M again. We're going to put your point back on the board.
All a matter of time. I love that. If you don't have a timeline for your prediction, it's nonsense.
All right. The world will continue to get more and more unaffordable. We proved that during 2020. The planners know that people will bow down and accept whatever. That was the same guy that gave you a point, by the way.
I'm very much in the camp of this, this overreaching government control, WEF, all of it. I think it's a real issue, but they don't automatically blend together instantly. And so I don't think everything's some sort of...
It's been happening since the 70s.
Right, but every little thing isn't causation and correlation. And so I think it's just good sometimes to step back and be like, okay, there's definitely sociopathic people who are unelected making decisions for the populace that are clearly out of touch and clearly aren't for the benefit of people. But it doesn't necessarily mean that every little thing thereafter is tied to some sort of, diabolical scheme. Walk off the ledge a little bit.
Well within the top decile of California income, but can barely afford median-priced home. Minimum debt, car loan, I'm waiting. How are regular people doing this? I think that's one of the reasons why people have exited California.
I agree, yeah.
Yeah, numbers don't work. 5% Fed rate is not restrictive. 5% is historically average. The fact even supposed conservatives act like it is illustrates how socialistic we are. All right, thank you, David. Appreciate that. Houses haven't been affordable since 1990s. What the hell is this guy talking about?
I actually said that. That's what I said.
Erasing your point.
I said the affordable housing.
Still only 1 point.
I know, but that's literally what I said. I said that we haven't had affordable housing since the 90s. Roll up, watch the game tape. So the last time housing has been this unaffordable was 2009.
Got it. All right. Here we go. Next one. Appreciation is a form of inflation. Equals proof spending power of dollar has drastically decreased now that it makes a difference. It is what? Not that it makes a difference. Thanks, Joe. It is all fiat monopoly money game, and rulers are closing down the game.
So my response to that is this game, this system, this machine gives them so much power, so much wealth, so much control. Why would they destroy it? So I think that's this walk off the ledge a little, back from the ledge a bit. I think the sentiment I agree with, that they're greedy, that they're creating systems and laws and policies that serve them. They're doing insider trading. They're doing all of these things because right now, the way the system is set up, people, they're not being prosecuted. I mean, the fact that, politicians like Nancy Pelosi and Elizabeth Warren and the rest of them have net worths of $300 million when they're making a salary of $250K. There's accounts on Twitter that basically track their trading, and it's just a big insider game. So I do agree with all of that, but I think that's going to continue to perpetuate. So what I would say is, do you want to sit there? Do we want to sit here in our armchairs and scream at our monitors and say it's all coming to an end because we hate it, or do we want to look at it and say this thing is corrupt either one, how do we get off our seat and change it? I don't have a good solution for that, to be honest, but I wish we had better politicians we could elect who would change it. Or do we start playing the game somehow so that we're not left behind? Unfortunately, across the country overall, I think everyone's chosen the latter, which is what we've talked about. I think people are getting into financial assets simply because they don't want to be left behind. And I'm not saying it's a good thing, but yeah, the system's broken. But don't sit here and think it's going to implode tomorrow because you know it's broken and you hate it. Chances are they're going to keep this thing going a lot longer than you ever imagined because it's giving them so much power.
One of the smartest guys ever been on the show. I was pessimistic when he came in, when he gave his intro, but I was wrong. All right. Well,
2 points.
now, well, I 1.5.
Thank you.
All right. Many boomers are becoming homeless due to inflation and living costs. They are not loaded.
So one of the things I'm really enjoying about this conversation is presenting a lot of opportunities to suggest or highlight when people when they're using generalities. Don't say many. What is many? Go get a number, be specific, understand what that number is relative to the entire segment of the population you're talking about. It's very intoxicating to use these empty words like many and everywhere, and go get the data, really look at it, because right now I understand that, people are using the adjustments in HOAs and assessments at properties and other types of insurances going up as a potential crisis for people in retirement states like Florida. It's a legitimate thing to be watching, but let's look at the data first. Before we extrapolate that 1,000 people are suddenly going to be what tops the entire housing market over, let's make sure we have the full picture. That's really the overarching point I'm trying to make with a lot of this stuff, is like, let's slow it down and really get crystal clear and objective about the data.
All right, we'll keep rolling along here. Austin again with his super chat. Thank you, Austin. John, the upcoming recession will be caused by the following X: no delinquent reporting student loans, BNPL, 40-year mortgage, FHA loans being given to 650 scores that are really 550 scores. Michael Burry, sense is on fire.
Read that again. What was it? Did he give us a list of things that he thinks is going to cause the recession?
Upcoming recession will be caused by the following: no delinquent reporting student loans.
Okay.
Valid.
Okay.
BNPL.
Okay.
40-year mortgage. Remods.
I don't see how that would cause a recession, but it's definitely something that I think it's another way they'll kick the can.
Yeah, I mean, when you look at it, and this is really, I guess, my whole thing with the 1 million+ remodifications that we've seen, where just call it forbearance of one way or another. My whole point is that how are they going to keep up their home? So, I mean, I think we're going to see, you talk about HOAs, a lot of these houses are in HOAs. I mean, they have to maintain them, or they can be fined by their HOA, they could be foreclosed on. These people aren't contributing necessarily to keep the economy going. They're struggling. All we did was push their loans on the back end. So a lot of them are going to still be in default.
Maybe. I mean, the forbearance thing, I think, is another one that's been...
if you're not fixing up your house and your HVAC breaks and it's $35,000 to replace it, and you needed a loan modification to a 40-year loan, how will they put heat back in their house? If they couldn't keep their mortgage payment, now all of a sudden they're going to come up with $35,000 to
No,
make
I understand your point, but again, this is this, like, let's paint this arbitrary story, and then...
That's a real story.
But I understand. I know people who have... These HOAs are ridiculous. Like, I know someone has to pay $5,000 to paint his garage. So I get it. I just don't think I think it's lazy thinking in a lot of cases to take a really heartfelt story and then paint this really broad stroke across the entire economy. These are real situations. These are real people in pain. There's real struggle there, but I don't think it reflects the entire economy or the overall health of the economy, but it doesn't mean that we can't see more of this stuff come up. Now, I think he mentioned NPLs, non-performing loans.
No. Yeah, BNPL, yep.
Yeah, so I think one of the things we haven't talked about here that's kind of interesting to me that I'm kind of keeping an eye on is in my opinion, based on where inflation has been year over year, it's coming down, but it's still not near the 2% target. That's if you even believe CPI. So CPI is nonsense. As soon as it doesn't look pretty, they make up another one called core. Then that doesn't look pretty, so they come up with super core. But the thing that I'm kind of paying attention to is because interest rates rose so quickly, and this was bond market driven, right? This is investors being like, inflation's going to be really, really bad. The Fed handed out too much money. The government handed out too much money. We need to get out of bonds. A lot of these banks, most banks, had to hold because of things like Basel III, Dodd-Frank, other types of banking regulation. They had to hold government bonds. It's the most pristine collateral. They needed that on their balance sheet. But they were buying these bonds in 2020 when the 10-year was 40 basis points. The 10-year now is 420 basis points. So that bond that they're holding got annihilated, right? So the bank balance sheets are massively underwater because of these bonds that they hold. But banks are able to do what's called mark to maturity on those assets. So if they had to sell those bonds today, they'd have to take a massive haircut. They would take a bath. But they can instead mark them to maturity, meaning as if they would never sell those bonds and just hold them for the 45 basis point, 0.5% yield until those bonds expired. So the banks can do that. So it doesn't look like they're insolvent. But when you look at those bond holdings mark to market, they are insolvent. And the reason why Silicon Valley Bank went bust is someone in the movie theater screamed fire. And there was only one exit, and that was to take your cash out. And so when Silicon Valley tried to raise capital to pay for the deposit withdrawals, they went bankrupt because the bonds that they were holding were massively undervalued versus what they paid for. That's across most regional banks and small local banks. My opinion is the only reason the Fed is even giving this kind of token rate cut later this year at some point is to kind of take some of the pressure off of those regional banks and the bond holdings that they have. If that wasn't a crisis right now, I mean, we can't roll back time. It is what it is. But if that wasn't a factor, if the regional banks weren't such a, in my opinion, the real risk to the economy, not the consumer, but the banking system imploding because these banks all of a sudden have bank runs nationally. If that wasn't a concern, I don't think the Fed would even be tickling the market with the idea of a rate cut right now. I think they would be raising again.
All right. Well, thank you, Austin. We'll continue here. We'll try and get these stored comments that we have here and wrap up because this is definitely going over the 2-hour mark. What's the big deal on 7% interest? Back in the 80s, rates were 14%.
I'm going to jump on that comment. Great comment, because one of the things that, again, people get really worked up about right now is the unaffordability aspect, which it is. But ironically, it was actually worse in the 80s. The peak unaffordability in the 80s was 1981. Peak unaffordability was 2022 in this cycle. And when you look at the payment to income ratio, in 1981, they were actually paying 19% more than people are today.
But the asset prices were nowhere near the price.
But
wait a minute. You had people staying at home raising their kids too. A lot of people were on one income.
No. That's not part of the. You can pull that out of the data. And it's not about That's why you compare the price to median income because you're taking the same apples to apples in both times. So yes, prices are higher, but median incomes are higher, right? So prices are higher, meaning the payment is higher, but the payment ratio to the median income is 19%.
Yeah, but you were buying houses at 3 times the median income, 4 times the median income. Now you can't buy a house at 9 times the median
Todd,
income.
this is why these.
So you can't pay 14%. I mean, the numbers don't work at 7%.
I'm telling you.
They work. they
Todd,
don't work.
Todd, I'm telling you what the data is, which is in 1981, they were paying 19. I'm not saying it's a healthy situation and that things are really affordable. I'm just saying this isn't the worst affordability in history. I'm saying not, in the 80s they had it worse by 19%.
You're only gauging it based on mortgage interest rates.
I'm gauging it by payment to median income ratio, which is the actual relevant comparison to the 1980s. Yes, yeah, they have to pay 8 times income, but so they had to do the same in the 80s.
Okay.
Just tell you what the data is.
Yeah. Well, I don't know what data you're looking at,
Okay.
but
I'll make sure I post it.
We'll post it.
Yeah.
All right.
I actually
Okay.
did post it on my Twitter.
All right. Here we go. It's not a switch that somebody just flicks, says John. Yet earlier he said the Fed bought mortgage-backed securities during the, he said, pandemic, and mortgage rates dropped into the 2% range.
So that is open market operations. That's very, very different than the Fed dictating monetary policy by choosing what the Fed funds rate is. I agree. That is them more or less flicking a switch in terms of artificially pushing interest rates down by going and buying bonds. But that is going way out on the limb on what they should be doing and is considered open market operations, which is slightly different.
All right. Still say petrodollar pulling out is going to sink us. We're not ready. We produce nothing.
All right, give me a timeline. Just give me a timeline. That's all.
Wage growth does matter. You don't make the same amount for 30 years. Wage growth does not matter. You don't make the same amount for 30 years. You lock in your payment and make more money. They are pumping out new houses like candy. Big supply ain't coming. They aren't pumping out new houses like candy. Big supply ain't coming. All right. We'll see about that too, because there are a lot of communities that home builders have a lot of homes that aren't moving. The major disconnect in every country, though, the major disconnect is in every country, though, isn't it? What country currency isn't based on debt? We always pay off old debt while acquiring new debt unless Ponzi coin is pushed on everyone.
Yeah, so I think I agree, this is a very important thing to keep in mind. The entire global financial system is debt-based. There is not enough collateral to pay back all the liabilities. There's not enough money in the system to pay back all the debt. If the debt doesn't grow continuously, then the system will fail. So it's the nature of the beast. We just have to keep playing or keep moving while the music's playing.
All right, and then we're going to take these final super chats and jump off for the evening. Thank you. Aloha. Is there any hope for the youth and housing?
I don't know. You know what? It's interesting. My nephew just purchased a home. He's in his mid-20s. He just graduated law school. Really bright guy. And I think, looking at what's going on in technology, a lot of the stuff, although I think cryptocurrencies in general are a bit of a scam. It's a lot of pump and dump, but there's also people who are building really cool stuff using that as the springboard. They're able to finance their creativity because there's so much capital, chasing these memes. But AI is, a big boom. I think the younger generation is dealing with technology and tools and efficiency that we've we can't quite wrap our head around, that I am optimistic for them, because I think they're going to be able to accelerate through different stages of life in their careers much faster than we could. And I also think they're going to be able to focus more energy on things that they're passionate about, because so much automation is going to be created to eliminate the mundane. And I think that could create a really interesting world where people are doing things that make them happy versus doing things that they have to do just to make a living.
All right, and we got Austin back here. He likes his data. In the 1980s, less than 25% of new homes built had an HOA attached to them.
Ooh.
2023, 63% have HOA. This is another cost that didn't exist to homeowners. I'd love to come on the show, Todd. Thanks, Austin. We appreciate it. Nor did they have the property taxes that they have now, or the insurance per $1,000 of home price.
Yeah, I don't know that granularity. It could be true.
Yep. And then we have David with the super chat said that 1980s mortgage income stat reeks of BS. So there we have it.
Denial.
All right. Well,
Logical fallacies.
We'll wait to see that, and we'll compare our real data when all things are considered in the cost of home ownership as to whether it is less affordable now. NAR, I think. NAR data only goes back, I think, to 2000 with the affordability, HAI, Housing Affordability Index in America, but I'm sure we can dig up some chats. But nevertheless, what a great show.
Dude, I appreciate it.
It was fun, John.
Yeah, thanks, Todd.
Man. So we're also going to record, while John is in town, another video that won't publish this week, but next week, not this Saturday, but next Saturday. So look for that. And keep your comments coming, and thanks so much.
Thanks, man.
All right.
That was awesome.
All right, buddy.
Appreciate it.
We'll talk to you soon. Thanks, guys, for watching our Tuesday night show. We love it that you spend your Tuesday nights with us. And remember, we're also in the business of helping buyers and sellers and tenants and landlords in Maryland. And if you're anywhere else, guys, we have an amazing broker network all over the country. Reach out. If you go to our website, sachsrealty.com, and you don't find somebody in your city, send me an email personally, and I will connect you with someone that I trust. See you next time.